Morning, everybody. Thanks for those that have joined already. We'll just give it a minute or so, and then we'll kick off. But yeah, morning, everyone that's joined. Thanks very much for your time this morning. Much appreciate it. Looking forward to chatting all things LiveMore and any cases that we can help you with. So yeah, we'll give it a minute, and then we'll crack on. Okay, so we shall begin. First and foremost, just a quick intro. So my name's Matt. I'm the head of underwriting here at LiveMore. Real pleasure for me today to be able to spend some time with you this morning to chat through what we do at LiveMore, and more specifically around some of the key aspects of our criteria, which we'll touch on. I want the session to be interactive, so please do ask questions. I'll come to as many of them as possible, mainly during the end of the session. That's where we want the real kind of time of the session to be for any cases that you're struggling to place. And on the back of me talking through some key aspects of criteria, we're sure that we can able to find a solution for those type of cases. So please do ask questions throughout the presentation. Don't feel like you need to wait till the end to ask a question. And as I said, I want it to be interactive and really then kind of get the insight from us in relation to how we can help you find those solutions for those cases that you're struggling to place. And again, thanks very much for your time this morning. It's much appreciated, and really looking forward to this morning. So these are the kind of four aspects that we're going to cover in the presentation, and the four things that we feel make us different as a lender. First is product choice. We've got the widest range of products available in the market for 50 plus. All incomes welcome, so we're really strong when it comes to affordability, and where we really see the benefits from that are in relation to really then being able to achieve those maximum loan amounts that your clients are looking for, and we'll cover in relation to all the different types of income sources and income streams that are available later in the presentation. We're really flexible as well when it comes to the different property types that we can lend on. So we can lend on other property types that in a lot of instances other lenders turn down. Again, we'll go into the more specifics around that later in the presentation, and we'll talk to our candor approach. I'm going to be biased because I'm the head of the underwriting team, but we like to do things differently here at LiveMore when it comes to underwriting. We want to work proactively with you. We want to make sure that relationship between lender and broker is balanced, and we will listen to you. We will want to proactively find out any kind of nuances around the case that then can help us in improve our understanding of the case. No one knows the client's specific scenarios better than you, and we really want to tap into that insight to again ensure that we can come out with a really positive solution for yourself and the client. So as I said, we'll touch on the individual products that we offer here at LiveMore. So we've got the retirement interest-only mortgage, so open-ended with no fixed term. We've then got our interest-only mortgage, which we can take to maximum age of 80. We've got our capital repayment mortgage, which the maximum age is 85. So again, that's with a fixed term in a similar way to the interest-only mortgage. And then we've got our equity release product as well. Again, no fixed term because it's equity release and no affordability or credit profile requirement for the equity release product. So as I said at the beginning, LiveMore originally launched with just the retirement interest-only mortgage nearly 4 years ago now. And what we've done during that time is really then add the different products to our suite to be able to then make sure that we can offer a truly agnostic product range to all clients from 50 upwards, depending on the clients and the specific needs that you're looking for and what solution that you're trying to find. We should then have a product within our suite to be able to help with that, mixed in with our criteria, which we'll go through a little bit later on in the presentation. So we'll start off with affordability and in relation to income and all the different income streams that we can accept. Essentially, all incomes are welcome. So we'll touch on employed income to start with. Essentially, we'll take all employed income up to 75 and 80 in some, but most cases. The sort of instances where we'll enable to take an income to 80 is instances where, for example, it's a professional role or an office-based role, essentially non-manual, so not builders or taxi drivers, bus drivers, that sort of thing will struggle to get to age 80 in those instances. However, for all of those roles that are non-manual, then we can look to take those income streams to 80. And the real benefit that we find in relation to them maximising the term that we can look to take the income to in those scenarios is that then whatever product that we're looking at, apart from equity release where there's no affordability requirement, we find that when an employed income stops and a pension stream comes in, which may not be as high as the employed income, because we've been able to assess the plausibility of taking that income to a higher age, we're then not finding a different affordability result when an income stream that's employed drops off and a lower pension stream drops in. So it's really beneficial that we can take that view and take that income stream to a higher age. And as I said, in the majority of cases and instances and scenarios, we can take that to 80, depending on what the client does. So from a self-employed perspective, self-employed income is acceptable. That does include retained profits if needed be. So we very often come across scenarios where applicants who are limited company directors and just purely take a dividend that they need each year. We can see from the accounts when we're assessing the application from an underwriting perspective that the business, they're able to take, for example, more out of the business, but they only take the amount they need for tax purposes. Again, because we manually assess all of these applications within our specialist underwriting team, we can really look into the specifics of the case, gain an understanding of it, and we will do that by proactively speaking to you about the case. And then we can actually look beyond a normal or traditional salary and dividends drawing from that business. We can look beyond that and look to use then a retained earning from the business. And again, that then maximizes the maximum ways that we can look at. When it comes to self-employed as well, we do have certain plans where we can accept just 1 year's proof of income, so 1 year's set of accounts, which is available on some of our plans as well. So we've got a lot of flexibility, not with just how we actually treat what income we can use, but also in relation to then how we actually assess it. We like to keep things very straightforward and simple for you when it comes to the actual processing and document gathering, essentially of the loan. We don't want to make things overcomplicated. So pensions, as you'd expect, we take pension income. We take it when it's in drawdown or not in drawdown. And again, we can take different income streams at different times of the lifespan of the loan. So I spoke earlier around employed income. When employed income then ceases, we can then look to then take a pension income, even if it's not currently in drawdown. The two common types of pensions we see are final salary or defined benefit pension, where it's a fixed amount. And we also do accept SIP pensions or a more kind of defined contribution pension. Again, we also, for those types of SIP pensions, we can also include ongoing contributions. So we'll use the percentage of the ongoing contribution that a client is making to that ongoing pension, which means if we're looking at a RIO, for example, where an applicant is pre-retirement, we can then base the affordability on their current employed pre-retirement income, and then at a fixed retirement date, which will be assessed in relation to the plausibility by underwriting, but essentially kind of really driven by the client in relation to when they tell us they're going to retire. And if they are making ongoing contributions to their pension pot, that will grow that pot. And that means that at retirement, we will then use that income stream into our affordability calculation to, again, really maximize the affordability for that loan. And again, more importantly, means that when the applicant retires, they're not penalized by then having a lower income stream, because that pot has been able to grow over the period of time from when we've assessed the application originally to when that is actually in drawdown. So a huge benefit that SIPs with ongoing contributions aren't just a fixed figure that's just going to be assuming no growth or any ongoing contributions in the future. We accept foreign income. The most common types of foreign income we see are foreign pensions. We also can use foreign income from rental property abroad. Um, and we quite commonly see with our demographic traditional rental income streams. So that's rental income within the UK, and also lodger income as well. So we see quite a few applications where the rent a room scheme, where you can I think it's up to 7,500 that doesn't need to be declared. We just need to see proof of it on a bank statement and proof it's been in receipt for at least 12 months. So just a bank statement from 12 months ago. So again, it's really maximizing these different income streams. We're aware that especially within our demographic, it's really common for our customers and applicants that we're dealing with not to just have traditional income streams like employed or self-employed income. We really want to maximize all different available income streams to again ensure that we're looking at maximizing the loan amounts that we can achieve. Linking back to self-employed, really, in relation to kind of cases where COVID has impacted income, we really want to, from an underwriting perspective, at LiveMore, look past the obvious and look past any life events that may have impacted or caused a blip in a client's income, for example. So it's not just where COVID has impacted income. What we can really do within the underwriting function at LiveMore is when we're assessing self-employed applications, if there has been a year where something has impacted the business, it could be COVID, it could be a unforeseen, machinery cost that the business then impacted profits on that specific year. As long as we can get comfort that in the most recent year that business is back on track, that's not going to be problematic in relation to using that income stream. Especially if we're looking at a RIO indefinitely or on one of our fixed term products over the duration of that mortgage, we don't want to penalise clients for a one-off event that's not a true reflection of how that business performs going forward. And just going back to pension incomes, where we, especially on RIO, when the death stress comes into account, we can use spousal pension transfers to then ensure that if an applicant is that the mortality is impactful on affordability, if part or all of that pension then transfers to the other applicant, we can then ensure that loan is then affordable over the full duration of that term. And it's not then hindered by the fact of an income stream has stopped for one applicant if some of that does transfer over. So there's all different types of income streams and different ways that we can model that to ensure essentially that we can get the maximum loan for your client. And most importantly, we can use different sorts of income streams. We're not limited to 1, 2, or 3 per applicant. So we can have an applicant who is employed with rental income, but they may also have a self-employed sole tradership on the side. They may have some, a foreign pension. Not all pensions all need to be in drawdown at the same time. We can look at the whole picture. And our affordability calculation from our website and on submission is super easy and really simple for you to then input all the details. And then we take it away and model it based on the client's circumstances. So in addition to the actual income streams, we do have some other methods that can also support affordability to, again, make sure that we can achieve the maximum loan available that yourself and your client needs. So we consider other assets, for example, cash savings or other financial investments. So most commonly, we see savings pots. It needs to be of a minimum of 10,000. And where we really utilise this is to bridge gaps in affordability. So you might have somebody who is already retired. They're going to be receiving their state pension in a period of time, so a year, 18 months time, and they have a cash pot that they can then planning to live on during that time where, for example, another income stream is shortly available. In the same way, in relation to an ISA, for example, applicants can then draw on a certain amount of that ISA and it will amortize over the period of the loan. Again, super easy in relation to how you input into that affordability. It asks for all the information, and us within underwriting will guide you then in relation to what's required from an evidential perspective to support that. We can also use equity from an asset to pay down the mortgage at retirement age. So again, linking back to the where the pension spousal transfers are really beneficial from a RIO perspective, or when an income stream stops at retirement. If we've got an asset that we're not using any of that if it's a buy to let, for example, if we're not using any of the income for affordability, so there may be an asset abroad or just an asset that's not rented out at the moment. If the applicant is then looking to sell that at retirement, we can use a certain percentage of that equity within that asset to essentially draw down part of the mortgage balance with LiveMore to then assess the new affordability on that lower amount at retirement. Again, really beneficial in relation to, especially when an employed income or self-employed income, ceases, and then going into that kind of post-employment and retirement phase where income streams may be lower. These are the sorts of levers that we can pull on again to make sure that we're maximising the opportunity and really taking into consideration the different types of assets and investments that applicants tend to have within our demographic. So moving on briefly, just to touch on how we view credit. So we do have plans that allow missed payments, again caused by life events. In a similar way that we assess self-employed applicants, we're aware that things happen. So we're aware that clients may have missed payments. We're non-judgmental in relation to that, so you won't get questioning from our underwriting team in relation to really digging into the details of why. If we need to ask you any specific situations about circumstances, again, we'll do that with ensuring that there's sensitivity around that and a non-judgmental view from an underwriting perspective. And that's not limited to just unsecured missed payments. We have plans that allow mortgage arrears, CCJs defaults, and also debt management plans as well. So if we do have any cases where there are some credit blips over the last 3 years, we do then have a plan within our product offering to enable that case to move forward and not be hindered by that by whatever that anomaly is with the credit file. And then moving on to property, so we can, as I mentioned earlier, lend on property types that other lenders often turn down. So the real kind of common types of properties that we see that fit into this bracket is close or above to commercial. It's very much our view at LiveMore that the majority of properties within the market all hold a value. So what we really do is work really well with our surveying partner, which is Connells, to make sure that they really understand our risk appetite when it comes to these types of properties. So what we're really looking for, especially when it's close to or in proximity or even above commercial, is the real social impact that the actual location of the property has. So, for example, if it's next to a country pub, is that really going to cause social disturbance that we're really concerned about the impact of the demands or future saleability of that property? In the majority of instances, we can really get comfort with that because we can prove that there is demand for these types of properties. So we're not put off by the fact that a certain property may be above or close to several different types of commercial units. But if you're ever unsure in relation to that, please do refer the case into us. The underwriting team can assess the property location, and then we can ensure that we're then passing on our wants and needs and our requirements to that when we then instruct the valuation to make sure that that's being considered when the actual appointment is taking place. But they're applications that we see on a daily basis that we get through. We're super comfortable with properties with annexes and outbuildings. I know some lenders do have a problem with that. Again, not a problem. It's also not a problem if they're on a separate council tax, for example. We expect most of them to have separate utilities. So if they are then rented out, that's absolutely fine. We can also take rental income from those annexes or outbuildings as long as they're not on a tenancy that lasts longer than 12 months. And again, we can cover that off from an underwriting perspective of the requirements that we're going to need to see in those instances. But we're essentially really happy and see again quite a lot of linking into the properties of acreage of up to 10 acres. Most of those properties will have outbuildings, and it's really common for those to be rented out. And again, it's not problematic for us at all. Something else that we're quite different to in relation to other lenders is lending to close proximity to properties in flood zones. We don't have an approach in relation to the fact of it being restricted to the actual gradient in relation to how that property is registered or what the flood risk is. The big requirement for us in relation to those sorts of properties is the property insurable? So we will ask to see, for example, a copy of the buildings insurance terms, and we will review the excess to make sure that the excess is reasonable, and not over a certain amount. Again, we can go through the actual requirements from an underwriting perspective when we look at the case. And if you do have any cases that are close proximity to flood zones that other lenders have an issue with, please do refer that case into us, because then we can then take that away from an underwriting perspective, review the overall profile, and then come back to you with a decision in relation to that. But we do have a different risk appetite when it comes to this to most other lenders. As I said, we're not restricted by the actual grade of the flood zone. It's more on the factor, right, is the property insurable, and are we happy with the overall risk factor of the property? Similarly, in relation to properties with escalating ground rent and high service charges, again, we don't have an actual kind of fixed amount. It's all based on overall percentages. So, for example, if we have a property with escalating ground rent, as long as it fits in with the estimated time that we expect from the mortality of the loan, as long as that fits in with a percentage, which is 2% of the property value up to 400,000 and 3% for 400,000 and above. Again, very different to the way that other lenders look to that, which is quite restrictive. And we've got a lot more flexibility in relation to how we view that, and we combine the two as well to make sure that that we're incorporating both the ground rent and service charges in relation to the escalations. And again, it means that then with properties with high service charges, for example, we're not restricted by having a fixed amount based on what the service charge is. So it means that then we can take those properties into consideration again, where other lenders, may struggle, that have more restrictions around actual fixed amounts when it comes to both ground rent and service charge. So just wanted to include this in relation to this, some of the typical kind of instances and scenarios and purposes that we come across in underwriting on a daily basis. You won't be too surprised to see any of these. We just wanted to make sure that we demonstrated the common cases and common instances for brokers to use us at LiveMore. First of which is the end of term. So customers coming to the end of their existing interest-only mortgage, and they may feel that they didn't have any options available to them due to income streams, due to current lenders not being able to extend the term. So we see that on a common basis. Touched on earlier in relation to the way that we treat adverse, we also lend for debt consolidation. We can lend for debt consolidation even if there has been credit adverse. So it's not like you can have one and not the other. So in a similar way to how we treat income streams, in relation to our purposes of our loans, they can be mixed. So as I said, we can have somebody who is at the end of their mortgage term, but they also have some revolving credit card debt that they want to then include within the mortgage to reduce their overall monthly repayments and increase their disposable income. Again, that's absolutely fine. It doesn't just need to be a fixed purpose. And then we also lend for purchasing, and then also for home improvements, for example, so capital raising. From an underwriting perspective, we, as I said earlier, we always want to be reasonable and keep things simple in relation to the evidence of that we're asking for. So in the majority of cases, we won't actually ask for the evidence of what that capital raise being, if it's reasonable and fits within the property value of the application that we're looking at. So and you'll find that across all of the underwriting requirements for when the team liaises with you about our requirements. We'll always make sure that, one, you're really clear on any requirements that we need and why it's needed, and secondly, and I guess equally as important, we won't ask for anything if it doesn't alter our lending decision. We're not just going to ask for things to disrupt the process. We like to make sure that for you, and most importantly the end client, that they're aware of any requirements and why we're asking for things. So we like to keep it very straightforward in relation to the actual processing of the application. So finish on some case studies which really kind of link into a lot of the information that we've already spoken about today, but it brings it to life because these are real instances where we've helped. The first one is where we were able to lend more from an affordability perspective based on a client's retained profits. So applicant ran a successful accountancy firm. It won't then surprise you that the applicant then just took what they needed from the business on a yearly basis to enable to then achieve the loan size that the customer needed. We needed to look beyond the more traditional stream of an income and a regular dividend, and we utilised using the retained profit within the business. The underwriting team were able to then assess the accounts to make sure that we were happy with the sustainability and the consistency of the not just the profit within the business, the cash reserves within the business, so that we can then make sure that we're comfortable that the client can take more on a ongoing basis and not just on a one-off. For example, if the business has had a out of ordinary really high year, we always want to make sure that it is sustainable going forward. In this instance, it meant that the applicant could get the full loan size that they needed on a 10-year fixed rate, where other lenders in this instance wouldn't recognise the retained profits. Next one we've got again is linked to affordability, and this one is also a really good example of the different types of income streams within an application that we can consider. The client didn't want to proceed with equity release because the sums didn't add up, and we were able to then offer the mortgage required, which actually then the purpose is one of the most common purposes, which won't be a surprise that we see at LiveMore, which is in relation to gifting to family. The applicant had different income streams, which included an annuity, state pension, and a SIP pension, and we were able to then achieve the maximum loan that the client wanted in relation to then gifting that to a family member. One of the actual pension streams at the time, the actual SIP pension, wasn't actually in drawdown at the time, because at the time of the mortgage, the client was state pension age and had an annuity, and they were then planning to draw on that SIP pension in a few years' time. They were making ongoing contributions to that pension as well. So linking to what I was speaking about earlier, it then meant that that pot size actually grew, so that then over the term of the loan was affordable, and the maximum loan was achievable. So it's a good example of how ongoing contributions can then really grow that pension pot over the time from the client, from when they're actually going to start drawing on that asset. And the last one is links in really to what I was discussing earlier about property. So as you can see here, client had a property next to a pub. Really struggled in relation to other lenders and their risk appetite in relation to the fact of it being fairly black and white in relation to, okay, it's near a pub, so we won't lend. It's not what we do at LiveMore. We really do look at the actual specific scenario, whether it's due to income, whether it's due to profile, whether it's due to property. And our underwriting team, because we manually assess these applications, can really then work with you and then work with, I guess, more importantly in these instances, our surveyors, to make sure that they really do understand our risk appetite when it comes to these types of properties. We were more than happy that the proximity to the pub wasn't impacting demand, wasn't impacting future sustainability, and in this instance, then we were able to achieve the full 300,000, where other lenders really just had an issue because it was near a pub. They looked at it in a black and white way. That's not what we do here. So this is a really good example of where we look beyond just kind of what's in front of you and what's on paper. And as I touched on before in relation to underwriting, what you can expect from us as a team, I guess you hear the phrase kind of direct access to underwriting kind of branded about a fair bit in the specialist market. We like to do things differently here. We're proactive with it, and you'll hear from us when you need to. Everybody loves a nice straightforward case. It comes in, it goes through the process nice and easy. We're not going to bombard you with phone calls, emails, and the like in instances like that. But where we really do come to life and where we really kind of enjoy it as well is the sort of instances where we've spoken about today, where it may need a little bit more understanding from an underwriter. It may, you may have had a lender turn an application down because they've looked at it in a black and white way, whether it be property, whether it be income, and we really need somebody, a decision maker, a mandate holder, to be able to actually, understand the complexity or the perceived complexity, because I think that's what it is sometimes of the case, and the underwriting team will really be proactive with that. and reach out to you to that so that they can gain that understanding. So we really do go above and beyond to be able to then find those solutions. We meet daily in relation to ensuring that those cases are listened to, so it won't just get lost in the process. So I meet with all of the team on a daily basis, where we come together and we discuss at daily credit meetings to ensure that we can come back with a solution in a timely manner. And also, what's also worth saying, if we can't proceed with something, we'll let you know at the earliest available opportunity. We're not just going to take you down the path and then move the goalposts at the end of the process. If we can't do something, we'll tell you at the start of the process. But what we'll always try and do is give something a chance and make sure that, as I said, we're liaising with you to find out about a certain aspect of that case, where other lenders have had a more yes/no approach to it. Just as the team, I'm sure they'll love me for using their photos, but we're available via the email address there. So any questions or queries that you do have, again, your account managers are always first on hand for that. They all liaise with us directly in relation to any kind of property or any other referrals you have. So underwriting are really at the heart of the actual property referrals or case referrals. That always comes through underwriting. So, for example, when you are speaking to your BDM or your account manager about a specific case, they're then coming directly into us to discuss that case. So underwriting are not just at the heart of our application process from when we receive an application in, it's pre-application as well, that we can really help with around the different kind of types of properties or income referrals that we have. So that is the end of the presentation. We've had some questions, so thank you very much for everybody that has asked a question. I'll come to these now. So we've got a question here in relation to with a retirement interest only, if someone has a flexi access drawdown pension, how would you assess income to lend against? So in relation to that, what we'd really need to understand from an underwriting perspective is the size of the pension pot. And then what we would then do in relation to what the affordability model will essentially do is use that pot. If it's already in drawdown, it will then amortize that pot of whatever size that is. Let's say it's 500,000. It will amortize that in line with the expected mortality of that applicant. That's if it's already in drawdown. If we have a pension pot that's not in drawdown, as I said, if there's ongoing contributions to that pot will grow because we'll use a certain percentage of those ongoing contributions. And then when the applicant tells us they're going to retire, if that's plausible, which the majority of the time it is, we don't tend not to question people about when they're going to retire. That's their decision. We really respect that. Then if there are ongoing contributions to that pot, that pot would have grown over that period of time. And then at that period of time, that will then amortize in the same way over that term in relation to linked to that applicant's mortality. So that's how we treat those pensions, the SIPs essentially from the pension pots. So I have a client here, a question here rather, for a client who will be 80 in March, still working as a consultant, and has an NHS pension and a state pension, like a standard interest only mortgage. So in relation to standard interest only, our maximum term at present for a standard interest only mortgage is 80. So, for example, I think this question is from Ray. Thanks for the question, Ray. We wouldn't be able to help for a standard interest only mortgage for this applicant at the moment. We would be able to help on a RIO. And that's just due to our current maximum ages. But the application from the eye test, looking at it there in relation to the incomes, we'd be happy if needed to take some of that employed income that they still have on the consultancy basis to possibly even in excess of 80, because there's other income streams there. So please do get in contact with us around that case, because it definitely sounds like something we can help with on a RIO basis. Okay, so had a question around foreign income, around types of currencies that we currently consider, and if we consider income from Iraq. We don't currently consider income from Iraq. We consider the main currencies. We can also add currencies to it. So if you do ever get any currencies that you're not sure, or in our product guide that it doesn't say it is acceptable, please do speak to us about it. So the common currencies we see are US dollars, euros, Swiss francs, Australian dollars, and we do also accept Saudi currency as well. There's a full list of the currencies available on our product guide. If something's not on there, as I said, please do refer that into us, and we can then take that away and come back to you. I had a question here from Robert around maintenance income, and if that's acceptable. The answer is yes. We see it fairly often in relation to marital maintenance, for example, where then an ongoing payment is then is made. It needs to be court ordered. We need to see documentation in relation to it. But maintenance income again is something that we see on a regular basis, and definitely is acceptable to us. Had a question here in relation to what is our maximum lend. So our maximum loan is 1 million. If you do have any cases that exceed this, please do speak to your national account manager, and they will then liaise with underwriting to see if we can then lend more than 1 million. In some instances we can. There's just a couple of different criteria aspects which we have to consider. So standard maximum loan is 1 million. As I said, if you do have anything in excess of that, please do contact your account manager in relation to that, and they can speak to underwriting, and we can come back to you. Had a question here from Dave in relation to, is it just salary that you'll take up to 75, 80, or will you consider self-employed sole traders? Yeah, it's not just limited to employed or a salary. If it's plausible, we can take self-employed sole traders to 75, 80. It's very much, as I'm sure you're understand already, it's very much scenario specific in relation to what that is. But again, linking back to the fact that we can manually assess those applications, there's not a blanket, oh, it has to fit in this bracket, or it has to fit there. We can look at it on that individual basis to ensure that then we can take that, if plausible, to those maximum ages. So it's not just linked to a traditional employed role that we can take those on to that longer term. I had a question here in relation to will we lend on retirement properties? So it really does depend on the type of property it is. So if it's a more traditional age restricted property and it's not a retirement complex or a retirement village, then that's fine. Where we would love to see more of the market go is in towards those retirement complexes, because a lot of lenders, well, the majority of lenders don't lend on those types of properties. It's really then difficult for us and our surveying partners to then give rationale around the demand and ongoing saleability of those types of properties. It's something that we're really promoting here at LiveMore, to be able to then kind of really maximise the potential of those retirement complexes and villages. So they're the ones at the moment we can't lend on because of the lack of demand for those types of property, or reduced demand for those types of properties. But a traditional age restricted property with with an age restriction, whether it be 55, 60, we can lend on those. And if you have a specific property in mind in relation to that, please do get in contact with us and let us know, and we can have a look at that for you. Had a question here from Ben in relation to our product tiers, and can we expand on that? So we break the product tiers down to we have 4 product tiers. So we have tier 1, 2, 3, and 4. Essentially, they're the real drivers behind the different debt consolidation levels that we can lend to, and all of the different credit adversity levels that we go to as well. For example, LiveMore 1 is our headline product and our headline rate. So that's a product that doesn't allow any adverse or any missed payments or debt consolidation, and that goes all the way through to LiveMore 4, which then does allow a really high percentage of the overall loan to be debt consolidation, and also then allows for our maximum allowable of mortgage arrears and CCJs and defaults. The product guide on the website goes through specifically exactly what is allowed on each tier. More importantly, it is really simple and straightforward to understand when you look at the guide. But more importantly, when you submit an application through us and it goes through the decision in principle mechanism, that does all the work for you and then tells you which tier it's applicable to. So you don't have to then manually select that yourself when you're submitting an application to us. I had a question here from Dave around what is the maximum number of applicants, and the maximum is currently 2. We are looking to expand that in the future. Whilst that is 2, we can also, as I alluded to earlier, still use other income streams, for example, lodgers, because that can include family members that reside with applicants. So while they may not be able to have additional applicants, for example, if 3 people live at a property, and you're looking to really kind of utilize from an affordability perspective, if they do contribute towards the monthly expenditure and they pay a regular income that we can evidence, we can take that into consideration. So whilst we can't at the moment consider more than 2 applicants, there are other ways that we can look at ensuring that we maximize the affordability for those loans over those periods of times, again dependent on the circumstances of and the scenario. There's a question here from Nigel in relation to how we would treat a standard interest only affordability, be assessed for a client age 66, remortgage from a high street end of term, is new loan to age 80 viable? Yes, Nigel, absolutely. You've not mentioned in relation to what the actual income streams are, but we can assess the affordability if that applicant, for example, linking to what we were speaking about earlier, is still working and plans to work to 80, and that is plausible, and they're and that's their plan, and it's a non-manual job, for example, there is a chance that then we can take the employed income to 80. If they're retired, then we'd base the affordability solely on their post employed income. So it really does depend on the actual specifics of what the income streams are, but we absolutely, these are the sorts of real common scenarios that we come across on a regular basis. We can definitely help with that, so please do get in contact with us in relation to that. Sorry, you just said they're already retired. So yeah, so we base it on their pension income, but looking at so dependent on the loan size and dependent on what the pension income is, yeah, we can definitely take that to age 80. So please do get in contact with us. We can help you around assessing the affordability of that application, but it definitely sounds like one that we can help with. And then the last, we've got a couple more questions. So I had a question here in relation to, can we use the value of a business if someone will sell as part of their retirement planning? So it really does depend on the overall scenario. So the short answer to that is yes, we can take that into consideration. It really then depends on the overall outlook of that application. The question has been submitted, so we'll get in contact with you post the webinar to actually speak about the actual overall scenario. But that is something in a similar way to we alluded to and spoken earlier about how we can use equity from an asset. We can potentially look at using some equity within a business to then pay down a mortgage as part of the retirement planning. So we'll get in contact with you to see to get a better understanding of the overall profile. But that's a really good example of how we can utilize other assets and investments that aren't traditional income streams. I had a question from David around rental income and buy to let is, I think it's 30,000 per annum and mortgage payments of 15. Net profits last 2 years average only at 5,000 due to expenses. This is a really good question, David, so thank you for that. All you simply need to do in relation to rental income is input the total mortgage payments and the total rental payments into our calculation. We then use the overriding profit. We're aware, for example, that due to expenses, a figure on an SA302, for example, isn't a true reflection of the overall affordability and the actual the true gain that the applicant is receiving from those properties. So our affordability model will then model it based on the rents, based on then the mortgage. We do exclude a slight discrepancy in relation to any rental void. So it's not just going to be 12 months rent minus 12 months mortgage. There is a slight discrepancy in there, but it's a lot more beneficial than just looking at, for example, what figure an SA302 shows, which we all know isn't a true reflection due to the expenses. Again, really simple and easy in relation to how you then have to put that into the affordability model. It just asks for the total figures, then we do the rest in relation to that. Rental income also automatically transfers on a death stress, for example. So if we are looking at a joint application on a RIO, for example, and an income stream is higher for applicant one because all the properties are in their name, that will automatically transfer over, and you don't need to do anything in relation to that. So last couple of questions, and then we'll wrap up. We've had a question from Paul in relation to: do you allow right to buy? Not at the moment. We do on a very regular basis, which wouldn't surprise you. Review our products with our product team, but at the moment, right to buy isn't something that we can consider. I've had a question from Steve about: can we do capital and interest as a repayment as well as interest only? Yes, we have a capital repayment product which we can go to maximum term 85. And again, all of the income streams and property types all apply to those different products as well. We don't have a different approach when it comes to affordability or our flexibility around income or property based on whether it be a capital repayment loan or an interest only loan. The flexibility really remains within our kind of our underwriting and our risk appetite. So if there aren't any more questions, we'll wrap up there. Really enjoyed that. Thank you very much for everyone that attended. Thank you everyone that asked a question. If you do have any other questions or have a case based on what we've spoken about today, please do get in contact with us. As I said, the underwriting team works really closely with our account managers and our BDMs, and we really do have a lot of involvement in relation to those case referrals. So if there's anything on the back of today that you think, I've got an instance like this, I really do help that, from the content we've covered, it's been helpful. It's enabled you to then think about LiveMore and how we can fit into those different scenarios. So please do get in contact with us. And if there's anything else we can help with, pick up the phone, pop us an email into our underwriting if there's anything I can specifically help with. But again, thank you all very much for your time this morning, and look forward to meeting some of you soon.